Silver didn't fall yesterday because demand disappeared. It didn't fall because technology stopped using it, or because inflation suddenly vanished, or because investors lost interest. Silver got smashed lower for one reason: rules changed mid-game. The COMEX and CME announced roughly a 30% margin hike on silver futures, and that single decision instantly forced leveraged traders to liquidate positions. This is a mechanism most investors don't fully understand, and that misunderstanding is exactly why silver markets are so easily shaken. Futures traders don't own silver. They rent exposure. When margins rise, the cost of holding contracts jumps overnight. If traders can't post additional collateral immediately, positions are closed automatically. That selling has nothing to do with fundamentals. It's mechanical, compulsory, and violent. And it disproportionately hits silver because silver is already one of the most volatile and thinly traded major commodities in the world. Right now, silver is trading around 70 plus per ounce in US paper markets, swinging wildly by the hour. But here's what most people don't realize. And this is where the story breaks open. Paper silver and physical silver are no longer the same market. In several parts of the world, physical silver is commanding dramatically higher prices. In Japan, for example, reports show physical silver selling at levels far above USO spot pricing, sometimes approaching nearly double the quoted futures price once premiums, scarcity, and currency factors are accounted for. That is not normal. That is not a temporary premium. That is a market fracture. Historically, when the gap between paper and physical widens like this, it signals stress, either supply stress, trust stress, or both. Paper markets exist to hedge physical supply. When physical metal becomes hard to source, the paper price becomes a suggestion, not a truth. Now add China to this equation. China is not just another consumer of silver. It is one of the most important processing and distribution hubs on Earth. By introducing licensing requirements to export silver, China is effectively signaling that silver is no longer treated as a free-flowing commodity. Export controls are not about profit. They're about strategic materials. Nations don't restrict exports of things they believe are abundant and replaceable. They restrict what they anticipate will be scarce, geopolitically sensitive, or essential for industrial dominance. Silver is critical for solar panels, electronics, defense systems, and advanced manufacturing. If export friction is already appearing, that means governments are preparing for tighter future supply. This is how restrictions begin, not with a total ban, but with paperwork, delays, approvals, and uncertainty. Markets hate uncertainty, but physical buyers respond by hoarding, not selling. At the same time, governments closer to home are quietly discouraging ownership. The state of Washington has implemented a 10.3% tax on gold and silver transactions, effectively penalizing citizens for moving into hard assets. This is not a coincidence. Throughout history, when currencies weaken and debt expands, governments attempt to trap capital, making it harder or more expensive to exit fiat systems. Taxation of precious metals doesn't raise meaningful revenue. Its real purpose is behavioral. It nudges people away from alternatives to paper money. The message is subtle but clear. Stay in the system even if the system is cracking. And while retail investors deal with taxes and margin hikes, banks, institutions that mismanage risk, receive emergency support. Roughly $75 billion in liquidity support was needed recently to stabilize parts of the banking system. That contrast matters. It tells you exactly who the rules are designed to protect. So ask yourself this: if silver were irrelevant, why tighten margins? If silver were abundant, why restrict exports? If silver were harmless, why tax ownership? These actions don't happen in isolation, and they happen when stress builds beneath the surface. This is why silver feels chaotic right now, because it sits at the intersection of industrial necessity, monetary distrust, and geopolitical competition. And if you're still watching, this is where you should pause and subscribe. Because what comes next is not about yesterday's drop. It's about whether silver can ever return to a free, transparent price discovery process. Drop your thoughts in the comments right now. Do you believe silver is being contained, or are we watching the early stages of a global metals conflict that no margin hike can suppress forever? To understand where silver goes from here, you need to understand why margin hikes exist in the first place. Officially, exchanges raise margins to reduce risk during volatility. Unofficially, margin hikes act as a pressure valve. They cool markets by forcing leveraged participants out. In theory, this stabilizes price discovery. In practice, it disproportionately benefits large institutions with deep balance sheets while wiping out smaller players who were correctly positioned but insufficiently capitalized. The key question is not whether the COMEX can raise margins again. It absolutely can. The real question is whether repeated hikes destroy the credibility of the futures market itself. Because when traders no longer trust that price movements reflect supply and demand, liquidity dries up. And without liquidity, Futures markets stop functioning as price-setting mechanisms. This is where manipulation accusations come from, not from conspiracy, but from structure. Silver futures represent many multiples of the physical metal available for delivery. As long as confidence holds, this leverage doesn't matter. But when physical shortages emerge, or when delivery risk increases, the leverage becomes dangerous. Margin hikes delay the problem by flushing out longs, but they do nothing to create new silver. They do nothing to increase mining output. They do nothing to resolve export restrictions. They only suppress price temporarily. History shows that when suppression fails, the rebound is not gradual, it's violent. Look at previous silver spikes. They didn't climb slowly, they exploded after long periods of attainment. Now layer in the idea of a global metals war. This isn't about tanks and missiles, it's about access. Countries are competing for control over the materials required for energy transition, defense systems, and technological dominance. Copper, lithium, rare earths, and silver all fall into this category. When strategic competition intensifies, free markets become secondary to national interest. That's when price controls, export limits, taxes, and regulatory friction appear. Silver is uniquely vulnerable because it's both a monetary metal and an industrial input. That dual role makes it politically inconvenient. Governments want cheap silver for industry, but controlled silver for investors. That tension cannot be resolved indefinitely. So, will silver continue to be manipulated, or will it trade freely? The honest answer is this. Silver will trade freely only when suppression becomes too expensive to maintain. Margin hikes work until they don't. Paper selling works until physical buyers refuse to sell. Taxes work until citizens accept them or circumvent them. Export controls work until global supply chains fracture. At some point, the cost of distortion exceeds the benefit. When that happens, price resets violently, not politely. The current divergence between paper prices and physical availability suggests we may be approaching that threshold. Where is silver headed? In the short term, expect chaos, whipsaws, margin hikes, regulatory shocks, and emotional price action. In the long term, fundamentals dominate. Industrial demand is not declining. Governments are not reducing debt. Energy transition is not slowing. And silver is not being discovered in massive new quantities. Those are facts, not opinions. Markets can delay reality, but they cannot cancel it. Silver's future price will not be decided by a single exchange announcement. It will be decided by whether the physical metal remains available at quoted prices. If it does, suppression continues. If it doesn't, repricing becomes unavoidable. So now I turn it to you. Do you think the COMEX will keep hiking margins until participation collapses? Do you think silver will remain a paper-priced asset? Or are we watching the early stages of a permanent structural shift? Where do you think silver is headed from here? Leave your answer in the comments. And if you want clear, data-driven breakdowns of markets before narratives flip, stay subscribed. This story isn't ending, it's just getting started.